Welcome to Forex Academy. Guys, trading the Forex market can be tricky if you dive in head first with no real training or solid education. So in order to help you out with your Forex trading, we have specially designed this particular course to guide you through the beginning stages of the trading and get you set on a course of consistently profitable trading. So let's start with the introduction of Forex market. But before that, let's take a quick look on disclaimer. Alright, speaking about the session outline, guys, first of all, we are going to have an introduction of Forex market, and then I will answer the question why we need to trade the Forex market instead of stock market, bond market, or commodity market, or any other market in the world. And then we will talk about what we actually trade in the Forex market, because as you know, this is all intangible thing, and this can arise concern like what we actually are trading. And then we are going to talk about different types of analysis, and then we are going to talk about currency pairs. So let's begin with our first slide, which is what is Forex market. Forex is a combination of two words, foreign and exchange. So it means that when we say Forex, it means that foreign exchange. Guys, before I proceed further, I would like to ask you a question: that have you ever been involved in the foreign exchange transaction? And I must say that most of you will be thinking that no, you have never been involved in the foreign exchange, you have never traded the Forex, you have because you are doing this for the very first time with our broker. So let me tell you that in reality the scenario is slightly different. Let's suppose if you are receiving funds from let's suppose you are a citizen of United States and you are receiving funds from the Eurozone, and you are receiving euros, and in order to use it in the United States, you have to convert them into euro to USD. So it means that as soon as you are converting euro to USD, or as soon as you are converting USD into any other currency because you are traveling to that particular country, so you are indulging yourself in the foreign exchange transaction. Alright, so having said that, the Forex market is nothing more than a place where we convert one currency into the other currency. So if you are doing this, you are already a part of a foreign exchange market. So what happens in the Forex market? As simple as that: we buy, we sell, we exchange currencies at the current market price. At the very beginning of this training, let me tell you the fact that the Forex market is one of the most traded markets in the world. And you can realize the importance of foreign exchange market, that the daily trading volume of foreign exchange market is $3.5 trillion, which is 50 times higher than the trading volume of New York stock market. By the way, guys, the New York stock market is one of the biggest stock markets in the world, and the daily turnover of the New York stock market is $75 billion, which is 50 times less than $3.5 trillion, and which is the trading volume of the foreign exchange market. Alright, guys, one of the reason behind why most of the people are trading Forex market instead of the stock market is that in order to analyze the stock prices, in order to analyze the stock market returns, in order to analyze in order to invest in the stock market, you have to be like professional financial analyst. Because let's suppose if you are investing in the Microsoft, if you are investing in the Apple company, you have to make your research, you have to analyze their balance sheet, you have to analyze their profit and loss statements, you have to analyze their monthly annual reports, their audit meetings, and many other things. So it is not a very it is quite difficult for a normal person to do so. So it means that even if you are doing this, you will not be able to perform the same analysis for multiple companies. So that is not the case with the Forex market. All you need to do is you have to have a good sense of the market. You need to have an updated news on any economy, and you need to learn about the fundamentals fundamentals and the technicals that you are going to learn in this particular course. So that is probably one of the reasons why investors feel more convenient investing in the forex market. And also, as I said in the beginning, that you are always a part of foreign exchange market. When you are exchanging one currency into the other currency, you are a part of foreign exchange market. And sometimes most of you, if you are having a bigger amount in any other currency, most of you waits for the good exchange rate. It means that you are analyzing the market, you are waiting for a good exchange rate in order to exchange your currency into another currency, so you get a better return on it. So probably that's one of the reasons why we got so much trading volume in the foreign exchange market. Guys, what I like most about the forex market is that it's always open 24 hours 5 days a week. Like, that is not open on Saturday and Sunday, but from Monday to Friday the forex market is open 24 hours a week. Unlike the stock market, definitely there when you are trading the stock market, you cannot trade overnight. You can hold your positions overnight, however you cannot close your position overnight. Let's suppose there is you got the stocks from the Microsoft. You got a news that there is some issue with the Microsoft company, probably the technology updates, or maybe the virus issue, maybe the hackers attacked. So based upon these sort of news, you cannot sell your stocks overnight. You have to wait for the market to open on the next day, probably at 9 a.m., and then you will be able to price in this information. However, and also one more thing, that you have to like, it is very hard for you to trade them during the night. However, that is not the case with the forex market. Even if you are doing a full-time job from 9 to 5, you will still be able to trade the forex market, because it's open 24 hours. So you can trade it at night, you can trade it whenever you want. So market offers you this market offers you endless profit opportunities, because of the reason this is open 24 hours. And every single day, as a result of constant price movement in the world, we can get the endless profit opportunities. All we need to do is we need to spot the trade opportunities, and then we need to take a position and then turn them into the profits. I will be speaking about how you can like predict the future prices, how you can like take the trades, and we will be speaking about where you need to enter in the market and where you need to exit from the market. It's just a matter of time. In the upcoming sessions, we will be speaking about these trading strategies as well. Speaking about what we trade in the forex market, guys, definitely this market is intangible. I am trading on the software. I actually sometimes, like during the initial years of my trading career, when I just started trading back in 2013, I was curious that how this actually works, and then I made my research on it, and I also studied in my during my MPhil, that the forex market is in the forex market we trade derivatives. Okay, now the derivative is one of the financial term that is being used in the financial market. Derivatives, as you can see from the, like, if we try to define it, it is derivation. Like, it's a derivation of prices. Okay, derivation of prices of what? Derivation of prices of securities that we are trading. So it's based upon what? So we are driving the prices of goods or services, probably not the services here. We are driving the prices of the currencies, or maybe the CFDs, indices, or whatever we are trading herein. So we are driving the prices of trading instrument based upon the demand and supply factor. So in simple words, the derivative is anything whose prices are derived from the demand and supply factors. So in this forex market, we trade future contracts, we trade forward contracts, we trade CFDs, and let me tell you what it actually is. Guys, as you know, we can also trade the commodities. Let's suppose I trade the WTI, crude oil prices. This is my agreement with the broker that I'm not going to take a physical delivery, and that is not an agreement with the broker never agrees to give you a delivery of whatever you have purchased from them. So definitely it will be very hard for me to store the crude oil if brokers gives me if I am buying the crude oil, and the broker by the end of when I close my position, broker comes to my doorstep and delivers me the certain quantity of crude oil. That is not going to happen here. So we can say that we are trading the future contract. The future contract is simply a promise between me and my broker that in the future I will be settling off the burden. I will purchase or sell certain commodity or certain foreign exchange currency at this future in the future at the certain date at the certain price, at the pre-decided price or whatever it is. So this is a future contract. It's a contract, it's an agreement that we are trading. It's an agreement which is going to mature in future, sometime in future, maybe after 2 months, after 3 months, after 5 months. That depends upon the maturity of the contract. So in order to simplify this, we can say that whenever I buy euro US dollar, I am not actually buying the euro, but I am buying the future contracts, or maybe I am buying the CFDs. The CFD is a contract for difference. The contract for difference means that it's a contract between me and my broker to adjust or to settle off the difference between the current market price and the selling price in future. So if I'm purchasing the CFDs right now, let's suppose I'm purchasing the CFD of gold, it means that I am buying the gold at 1300, and after 10 days when I close it, the broker is not going to give me the delivery of gold, but they are going to settle off the difference. Contract for difference. They are going to settle off the difference between the buying price and the selling price. If the buying price is lower than the selling price, definitely I will get the positive profit in my account. They will credit this in my account. Otherwise, they will debit it from my account. Let's suppose I purchase the gold at $1,300 per ounce, and after 10 days or 15 days or 30 days, the gold prices are down at $1,250. It means that I will be facing a loss of $50, which means that this particular loss will be deducted from my trading account. So that is what we call a contract for difference. So if you guys are wondering like what we trade in the forex market, guys, all that we can trade here is the CFD or future contracts, which means that no physical delivery at all. So the idea behind buying currency is actually very simple. Why we all we need to decide is why we need to buy it, why we need to sell it. Or we have to decide whether we need to buy it or whether we need to sell it. And in order to do so, we take help of the market analysis. Speaking about the market analysis, guys, just like any other market, when we have to purchase anything or when we have to sell anything, we do conduct a very precise research about it. Like let's suppose if I want to purchase a mobile phone, I will conduct my research. I will maybe ask my friends about the better mobile phone. I will make my comparison between the iOS devices and Android devices. Probably I will make my research why I need to go for Apple or whether I need to go for Samsung. So it means that I am making my comparison. Likewise, I will also be asking my friends if any company is offering discounts, or if any shop is offering any discount. So I will go there and I will purchase the mobile phone from that particular shop or from that particular store, because I will be getting it cheaper than any other store in the market. Likewise, I will be seeing that which store is offering after sales services, which company is offering good probably 2 years of warranty or 5 years of warranty. It means that I am conducting my analysis. I am seeing that which company is better for me. Just like that, in order to invest in the forex market, we got like hundreds of currencies. Like we got euro, we got dollar, USD, JPY, Canadian dollar, Australian dollar, Mexican dollars, Swiss francs. So we got many currencies to invest in. But we conduct our analysis in order to decide which currency we need to invest in. When we are doing so, we are basically trying to forecast if I'm intending to buy the US dollar, or if I'm intending to buy the GBP. I have two options to invest in. I will be forecasting the future prices, where the prices of GBP can go and how high the US dollar prices can go. So I can conduct this analysis in three ways. Like we got three different types of analysis. The number one is fundamentals analysis, number two is technical analysis, and number three is sentiment analysis. Guys, we are going to have a massive discussion about fundamentals, technical, and sentiment in our upcoming sessions. But right now, just for the sake of giving you a quick idea, the fundamental analysis is basically when we try to forecast the prices based upon the past economic events, based upon the ongoing geopolitical economic events, based upon the macroeconomic events. When we are deciding this news is likely to impact the market in this particular way, this is called fundamentals analysis. Whereas on the other hand, when we speak about the technical analysis, we are trying to forecast the future prices based upon the past prices, or we can say that in the past 10 days the trend of gold has been bullish. The prices has soared from 1300 to 1350, so probably today the gold prices will go higher. It means that we are trying to determine the gold prices based upon the past prices. Lastly, guys, this market is also about the sentiment analysis. Sentiment means what you are thinking. If I am able to understand, if I am able to predict what you are thinking, then I can decide my position as per your thinking. And guys, when I said that what you are thinking, I mean that I am speaking about the overall market. If I am able to predict, if I am able to forecast what 50%, 70%, or maybe even more than that percentage of investors are thinking, what they are thinking of doing, I will take my position in the similar direction. If they are thinking to buy US dollar, I will also invest. I will also buy the US dollar. Or if they are like looking to sell the US dollar, I will be looking to sell the US dollar as well. So yeah, that's how we can perform the market analysis. Now let's speak about what is currency pair. Guys, in the forex market, currencies are being traded in the form of pairs. For example, Euro USD, USD CHF, GBP JPY, and GBP USD, USD JPY. It means that buying and selling currencies simultaneously. Let me give you an example. For example, I am visiting the United States and I need to buy US dollar, and what I got is the euro. I have euros in my pocket, but I do not have USD, so I go to the exchanger, I give them euro, and they give me dollars in return. So we just performed a transaction. What I did was I have sold my euros and I purchased the US dollar. It means that in order to perform a transaction, it's a two-way process. We sell something and we buy something, just like any other product. Let's suppose in the market, if I want to buy an iPhone, or if I want to buy a Samsung, I need to give price for it, and the price for it probably $1,000, maybe 800 euros. So I will be giving 800 euros, or I will be giving US dollars in order to exchange it with the mobile phone. So the idea here is what determines the exchange rate. In case of just like if we compare it with the iPhone or Samsung, the exchange rate, the price of this particular product is determined based upon the demand and supply factor. Like if there is more demand for iPhone in the market than the Samsung, definitely the prices of iPhone will be higher and the prices of Samsung will be lower. And if we compare it with the Huawei, definitely the prices of Samsung will be higher than Huawei. So there is going to be the demand and supply factor which will be impacting the exchange rate. Likewise, the GBP USD and USD JPY, the exchange rate between all of these currencies will also be determined by the demand of US dollar and demand of Japanese yen, or demand of US dollar or demand of the sterling. So that's what decide the prices of the exchange rate of the currency pairs. So yeah, that's what we said. Demand for first currency, which is called base currency, or supply for first currency, base currency. So demand and supply for USD will determine the demand and will determine the exchange rate between the USD and JPY. So having said that, guys, these currencies are basically called base and core currencies. For example, in case of Euro USD, one currency is base currency and other currency is the core currency. So let me define what is base and what is core currency. The base currency, or the currencies you are buying when you trade the forex pair. The core currency is the currency that you are selling, or when you trade the forex pair. Let me make it more clear to you. There is a detailed definition here. As you can see, the base currency, the main instrument of the pair, the first currency to appear in the currency code. On the left side, the USD, Euro, GBP, AUD, CHF are the most popular bases. For example, if you see here in the example, you can find that the base currency is the GBP. GBP is coming on the left side, is the first currency in the pair, is a base currency. It means that whenever I make a purchase or whenever I make a sell, I will be selling or buying the first currency. For example, in case of GBP USD, I am making a sell transaction in the GBP USD. It means that I am selling GBP. And in case of buying buying GBP USD, I will be buying GBP, because whatever I do, I am doing it with the base currency, and the second currency will react exactly opposite. Let me give you an example once again. Let's suppose in case of Euro US dollar, if I buy Euro US dollar, it means that I am buying the base currency, which is what? Which is Euro, and I am selling the code currency, which is the second currency in the currency pair. So we can say that base is the first currency, which is a GBP, and the code is a second currency, which is USD. So it means that how many units of, we can say that how many units I need to sell in order to buy the single unit of base currency. So if I want to buy GBP, I need to give 1.41 USD. So if I want to if I want to buy Euro USD, I need to give like 1.12. Let's suppose the exchange rate between Euro USD is 1.20. So I need to give 1.20 units of US dollar in order to buy the Euro currency. So that's what we call the base and code currency. Now the concept here is bid and ask price. It is very important to understand the difference between bid and ask price, and also then we will speak about the spread also. So the bid price is I believe let me move to the next slide. The bid price is the best price at which you can sell the base in order to buy the code currency. So it means, in simple words, bid price is a sell price and the ask price is a buy price. So if I define, ask price is the price offered by the broker in order for me to buy base currency in return of a code. So to make it simple, you can say the bid price is a sell price, the ask price is a buy price. And if we speak about the spread is the difference between bid and ask price. So it means that it's a difference between the selling and the buying price. So here you can see here, that is a screenshot from the MT4. By the way, guys, we are also going to have like a video on the MT4. I will in the next upcoming videos, you will be seeing an introduction to the MT4 and all the features that you can use, and in order to make it use in your best interest. So this is a screenshot from your MT4. Here this is a symbol is Euro USD, and the first price is bid price. It means and the second price is ask price, which means that the bid price is the selling price and the ask price is the buying price, as we spoke about. And the difference between both of them is the spread. For example, the buy minus sell price is the spread. For example, 1.1128 minus 1.1195, which is 3, which means that there is a spread of 3 pips. So a spread, guys, for your information, spread is known as it is also known as a commission of a forex broker, or this is also called the service charges by a forex broker, because definitely they are offering you the trading services, they are assisting you with the execution of your position, they are assisting you with the some support and services, deposits and withdrawals. So that's what they charge for their services, and that is the same case with any other product. Let's suppose that I got a superstore and I am purchasing, I am a retailer, I purchase products from the wholesaler at the lower prices, and then I sell it to the retail consumers on the higher prices. The difference between my selling price and the buying price is my spread. It means that this is my profit. So guys, lastly, there are three different types of currency pairs that we trade here. The first type is direct currency pair, the second one is indirect, and third one is the cross currency pair. Okay, which ones are major? First of all, before describing which ones are major, let me define what is direct currency pair and what is indirect and what is cross. Guys, the direct currency pair is a currency pair where US dollar is in denominator, first thing. Second thing, the US dollar is a second currency, or US dollar is a core currency. Probably let me change the color of my marker so it will be more clear. Blue. Alright, so US dollar is in denominator. It means that it's a second currency, like euro is on the upper side and the USD is on the lower side. So the first currency is euro, second currency is USD. So dollar is in the denominator. It's a second currency, it's a core currency. That is a direct currency pair. In case of indirect currency pair, dollar is in the numerator, it's a first currency or it's a base currency, just like USD JPY, USD CHF, or USD Canadian dollar. So you can see the difference here. Euro was on the top and the USD was then on the second, on the right hand side, which was the second currency. However, in case of indirect currency pair, that is USD on the top and JPY on the second. However, in the cross currency pair, we do not have a dollar in it. It's like it's like any other currency pair. It's a pair of any other currency. We do not have a US dollar involved in it. It means that if we got macroeconomic events, if we got any news regarding US dollar, whether this is going to stay bullish or bearish, we do not have to worry about the cross currency pairs. And let's suppose if there is some sort of news which is going to be released in 3 hours, 4 hours, or in a day or so, and I'm feeling hesitant to trade in the direct currency pair or indirect currency pairs, I can go for the cross currency pairs, because there is no US dollar. We got other currencies in the denominator and in the numerator. So this is what we call the cross currency pair. And guys, lastly, why it is important to know about why it is important to learn about the currency pairs. First of all, guys, there is a tug of war between bulls and bears when we speak about the euro and USD. When we speak about the GBP USD, we need to identify which currency pair we need to buy, and we need to identify which currency pair we need to sell. For example, in case of euro US dollar, like here, it's a dollar index. It is representing the strength of dollar against 6 other currency pairs. So for example, the dollar is getting stronger for now. Here you can see the recent trend of the dollar. Here the dollar is getting stronger. So what's going on with the other currency pairs? For example, euro is falling down because it's the exchange rate between euro USD. So it means that dollar is getting stronger, so that's why I have to pay less amount of dollars in order to buy 1 euro. But on the other hand, if we speak about USD JPY, this currency pair is getting higher. It means that I have to pay more in Japanese yen in order to buy 1 unit of dollar. So the thing is here that when dollar is getting stronger, I will be buying the euro USD. However, I will be selling the USD JPY. It means that this is very important to understand that which currency pair is the direct, which is indirect, because in case of stronger dollar, I will be selling the direct currency pair, and I will be buying the indirect currency pair, because in case of stronger dollar, I want to buy USD. So if I sell euro USD, it means that I am selling the base currency and I am buying the code currency. Likewise, here if I am if I want to take an advantage of stronger dollar, I will be buying USD JPY, because USD here is a base currency, and whatever we do, whether we buy or sell, we are doing it with the first currency, which is base currency. So I will click on the buy position, and when I do so, I will be buying US dollar and I will be selling JPY, because I believe that dollar is going to get stronger against any other currency, that can be JPY or that can be Canadian dollar. So there are some major types of currency pairs. Like if we speak about the major currency pairs, guys, Euro US dollar, USD JPY, GBP USD, the GBP USD CHF, USD Canadian dollar, Australian dollar, and US dollar, and New Zealand dollar, and US dollar. So then we speak about the minor currency pairs. These can be Euro CHF, this can be Euro GBP, Euro Canadian dollar, Euro Australian dollar, and Euro New Zealand dollar. These are the euro majors, guys. This is I'm telling you this because if you are a good if you are a very big fan of trading the euro, you got all the currency pairs related to euro. And if you are well aware about what is going on in the eurozone, and if you are very confident about all the activities which are being done in the eurozone, so simply you can trade these currency pairs. On the other hand, if we speak about JPY, we got these crosses like Euro JPY, GBP JPY, CHF JPY, Canadian dollar JPY, and Australian dollar and JPY. Likewise with pound, we got these four currency pairs. Lastly, guys, my most favorite currency pairs, which are very volatile, and the average daily movement is around 100 pips or even more than that. These currency pairs are from majors. These are Euro USD, GBP USD, USD JPY, Australian dollar and USD, and Canadian dollar. And in the minors, that is Euro JPY, GBP JPY, Euro GBP, and Canadian dollar and Japanese yen. So that's it for now, and in the next video we will be talking about the basic terminologies that you should know, because you are going to become a part of Forex world and you should be aware of these terminologies. So for now, that's pretty much it, and see you guys in with the next video.